Hi, this is Pete Andresen with Andresen & Associates, and I'm here to talk about the financial markets in the first 3 months of 2024. Yesterday we had an eclipse, a partial eclipse. It wasn't the whole thing out here in California. And we all put on our glasses like this. These are eclipse glasses, and we went out and we stared at the sun and watched this eclipse take place. And it was truly remarkable, and in its bizarreness, among other things, the bizarreness of staring at the sun, it reminded me of the Standard & Poor's 500 in the first 3 months of 2024. Just astonishing. Let me quote Reuters here. This is Reuters News Service right after the quarter ended on March 31st. The S&P 500 has climbed more than 10% so far this year to post its biggest first quarter gain since 2029. The benchmark index in late January hit its first record high in 2 years as it built on a surge in late 2023 and has not looked back, setting more than a dozen highs without a significant pullback so far in 2024. Holy cow. Take a look now at this graph. That's what the S&P 500 did. Remember, the S&P 500 really isn't 500. It's dominated by a few core stocks. We've talked about that in recent videos. But what makes this even more remarkable is that it's different from what was predicted at the end of 2023. Once again, the people, the experts who predicted what was going to happen in 2024 have so far been wrong. And frankly, I was surprised by this as well. Here's the predictions, basically. There will be no recession, but there will be a slowdown and a soft landing, even though there has never been a soft landing that I know of in history, in modern history. Investment returns will be lower than normal for the next decade. Remember that? We had a whole video about that. Small stocks and international stocks, because of valuation, because the S&P 500's core stocks are so overvalued, small stocks and internationals will outperform. The S&P 500 is overvalued and will soon experience a mild correction. That didn't happen. Inflation will drop below 2%. Interest rates will go down a lot, and as a result, bonds will probably outperform stocks in 2024. I happen to believe that. Here's what really happened, though. Let me take a look at this graph. This is the line on top is Bitcoin. There's Bitcoin. Gold did great. There was no recession, no soft landing. Look at that Bitcoin. Look at that stock market. Small stocks and international stocks underperformed again. But the thing that's big, I mean, this is the big thing. Inflation stayed above 2%. Inflation did not come down. And the Fed signaled, their lips moved, they signaled that they might cut interest rates 3 times in the coming months of 2024. And that probably was the core message behind what happened in 2024 so far. So interest rates did not go down. They went up a little tiny bit, and as a result, bonds went down a tiny little bit. And this was very frustrating to me because what happened was, here I am, here we are, we're allocated, we're diversifying, we're doing what's prudent, and the basic concept of that is that as interest rates come down, the bonds will provide a great counterbalance to any stock market decline we experience, and they will go up. They're supposed to go up more than the stock market, basically. But right now we've got half of our portfolio or a third of our portfolio or whatever as dead weight, which is right back where we were when interest rates were 0. Quite frustrating. So here's, I'm reaching for the graph here. So why don't we just ditch the bonds, chuck it, discard any concept of valuation or rational thought, and let's put less in bonds, sell those, and get into equities, because equities are going up, right? That might be the right way to do it in the proper financial environment now. I don't think so. History says the following, and I'm reading again. This is from Morningstar, who did a study. They did a study and it said that a 60% stock, 40% bond portfolio improved risk-adjusted returns versus an all-stock benchmark in more than 87% of the rolling 3-year periods starting in 1976. Now, that's saying to me that historically we're living through a period where it's an anomaly. It's probably an anomaly that was created with the 0% interest rate, maximum debt creation era. At some point, we're going to expect interest rates and bond performances to return to normal sometime in the future and stay that way for a reasonably decent time. Now, that's either true or the basic tenets of valuation in investing or debt. Take a look at this graph. That's valuation of the S&P 500. And as you can see, it's now more overvalued than it was. In fact, you could make another statement here, and that is that what we saw go up in the first 3 months of 2024 were the risk proxies. In other words, investors are now assuming, because the Fed's lips have moved, that they're ready for this bailout, that it is okay to just invest as though there is no risk. Because really, there hasn't been any risk since about 2008, any lasting risk. There's no real risk of a downturn, and a recession sure hasn't happened. So I would offer for your consideration that Bitcoin has lapsed into a VIX indicator, a volatility or risk indicator. Gold is doing the same thing. Gold used to be correlated to inflation. Then it wasn't. Then it was correlated to deflation in the 0% interest rate era. And now it's just correlated with happy days are here again and there is no risk. And that may be true. And it's a good thing we're diversified because we are participating somewhat in these upward moving markets. But let me put this graph right here for you to take a look at. That's the yield curve. And as you can see, the short end over on the left is the interest rate is higher than the interest rates farther out on the yield curve all the way out to 30 years. This is from Schwab. Let's take a good, strong look at that. I cannot find an era in which shorter-term bonds delivered a higher interest rate than longer-term bonds without predicting a recession. Now, that recession absolutely does not seem to be happening here, and it may not happen. But we are truly moving against history if we think that happy days really are here again, that the inverted yield curve does not signal a problem, that all these investments truly signify that all risk truly has gone away. That's a big reach, and especially since my first job is to keep you rich, not make you rich. I'm supposed to protect your assets first. My thought is split it in the middle. So with that in mind, here's what I'm going to do. Okay. I am going to read from some notes here about what I'm doing. My first thought is I am going to practice a centrist strategy. That is, don't buy any more risky investments, but also I'm not going to sell in taxable accounts. So it symbolizes the ambivalence that I think is truly out there. It is incredibly possible that the new paradigm is correct. However, I have to say that I've never, ever in my 40 years of doing this, well, 39 years of doing this, seen the new paradigm be correct. If an investment is now priced at all-time highs like Bitcoin, gold, and the S&P 500 in technology, I am not going to buy it right now. I don't care how much it's been going up. I don't care how slow this is agonizingly slow. I cannot do that in good conscience. They're all good investments, but they seem to be overpriced. And what history tells me is that buying at a high price leads to grief. Never seen it end any other way. So, call me if you want more S&P 500 or risk exposure. Call me. Just tell me. Our clients have, and I've done it. I think that a recession and even a stock market downturn are possibilities, but not absolutely certain. If we have a return to normal, our bond portfolio is going to rock it, most probably. And I want to be there for that. Outside of retirement plans and IRAs, though, and here's where my compromise comes into being, I am not selling off I'm not rebalancing, I'm not selling off, because the fact is that we've been wrong for 5 years. So I am not going to sell your index funds. I'm not going to sell your S&P 500 ETFs. To do that outside of retirement plans is going to trigger massive taxes for you. And here's the deal. When I do that, when I make that choice, what I'm doing is I am introducing fairly substantial risk into your portfolio. I'm allowing the risk to grow because the S&P 500 is riskier and riskier as it becomes more and more overvalued. And thus I'm exposing you in your non-retirement accounts to the risk of a declining market. And it can really decline. History tells us the S&P 500 can drop 50%. It's unlikely, but it might. And I really can't say it won't. However, it goes on and on and on. And my thought is, in these non-retirement accounts, that we will buy more when they decline, because right now to sell out in a place where I don't know for sure what's happening, to sell out of those accounts will trigger taxes that you shouldn't have to pay. And I'm going to call upon your courage when things decline. So expect that. Things are getting riskier in those non-retirement accounts. What do I really think? I think it's going to go back to normal. I think this is, gosh darn, slow and very emotionally challenging. And I might be wrong, but I think that history is on our side. So, most of all, please call me. Tell me what you think. Let me know what you think I should do in your portfolios. Otherwise, I'm going to continue to pursue this compromise solution that I'm aiming at. Meanwhile, it's spring out there. I got sunglasses. The grass is green. The flowers are blooming. Let's make the most of it. And blessings.